Most people overcomplicate investing. They think they need to start with thousands of dollars, own a bunch of properties, or have a big inheritance to build wealth. This belief quietly kills dreams because it makes people delay starting, and in compounding, time beats money every single time. Compounding is not just a financial principle. It's the silent, invisible engine that has built fortunes for centuries. It's what turns small beginnings into massive outcomes and what allows ordinary people with no lottery wins, no family inheritances, and no millionaire salaries to grow into a level of financial independence most people believe is impossible for them. But here's the problem. When people hear about compounding, they often focus on the big results and ignore the small beginnings. They hear about Warren Buffett making billions through compounding and think, well, that only works if you already have millions. That belief alone is why most people never let compounding work for them. They wait for a perfect time, a big windfall, or a moment when they finally have enough to invest, without realizing that the very power of compounding comes from starting with the smallest possible amount. So the question is, what's the absolute lowest amount you need to let compounding work for you? The answer is shocking for most people, not because it's too high, but because it's much lower than they think. The truth is, you don't need thousands or hundreds. You just need an amount so small it forces you to confront the uncomfortable reality that the only thing holding you back is not money, it's your mindset, your patience, and your consistency. So let's answer the question, what is the lowest amount you need to let compounding work? Before we talk about the number, you need to truly understand what compounding is, not in a textbook sense, but in a real-life, emotionally charged way that makes you see why every single coin matters. Compounding happens when the returns you earn on your money begin to earn returns themselves. Over time, the growth is not linear, it's exponential. The early years may look slow, almost insignificant, but the later years are explosive. Compounding is not about how much you start with, it's about how long you allow the process to run. Time is the greatest multiplier, and every day you wait to start is a day you can never get back. When you understand this, you realize that starting with even $5 is infinitely more powerful than waiting for the day you can start with $5,000 or $10,000. Now, here's the reality. The lowest amount you need to start compounding depends on three things: the investment vehicle you use, the frequency of contribution, and the mindset you apply. With modern investment platforms, you can start investing with as little as $1 in certain index funds or fractional shares. Some apps allow you to buy fractions of stocks or ETFs, meaning you don't need hundreds to begin, you just need something. From a purely mathematical perspective, the lowest amount can literally be one single unit of currency in your country. But from a behavioral perspective, the lowest amount should be the amount you can contribute consistently without fail. That might be $1 per day, which is $30 per month, $5 per week, which is $20 per month, and $50 per month if you can stretch further. The magic is not in the size of the first deposit, it's in your ability to add to it consistently and leave it untouched long enough for compounding to do its work. Now, here is the twist of it all. Yes, you can technically start investing with as little as $1, and over decades that dollar will grow, but starting too small often kills motivation before compounding has a chance to work. When your initial amount and contributions are tiny, growth is painfully slow, so slow that most people give up long before seeing results. For example, someone might start with $50, check back in 6 months, and see it grow to just $53, then decide it's not worth it and pull the money out. This is like planting an apple seed and then abandoning it a week later because there's no orchard yet. The early phase of compounding is always the slowest. And unless you understand that this stage is about patience and consistency rather than instant gratification, you'll quit before your money ever has a chance to build momentum. The real lowest amount you need to let compounding work isn't just about starting with the first dollar. It's about reaching what can be called your momentum number. Momentum is the point where your investment growth in a single year is greater than the amount you personally contributed that year, meaning your money has started working harder than you are. For many people, this number falls between $10,000 and $20,000 invested, depending on the rate of return. At a 10% annual return, $10,000 generates about $1,000 in growth in a year, and $20,000 generates about $2,000, which begins to feel substantial compared to your own contributions. This is the emotional turning point where you can see the magic of compounding with your own eyes, and once you see it, you're far more likely to stay consistent and let the process keep working for you. With that in mind, the lowest amount you need to let compounding work can be thought of in 3 stages: seed stage, growth stage, and freedom stage. The seed stage minimum is between $500 and $2,000, where the purpose is simply to start and build the habit of investing. Growth at this level will feel slow, but this stage is about training your mindset, not just growing your money, because without forming the identity of an investor, you'll never move to bigger gains. The growth stage minimum is between $10,000 and $20,000, where yearly returns become noticeable and can compete with your contributions, making the power of compounding visible and motivating you to keep going. The freedom stage minimum is $100,000 or more, where compounding accelerates toward financial independence, and your money can start earning more than some full-time jobs, giving you the ability to buy back your time. Each stage has its own emotional payoff, but together they form the path from simply starting to reaching a point where your money works harder than you do. The best way to find the lowest amount you need to start compounding is to work backwards from your goal. First, decide the target amount you want to reach, then determine your time frame. Estimate your average annual rate of return, and figure out how much you can contribute consistently. From there, you can calculate the smallest starting amount and contribution combination that will get you to your goal. For example, if your goal is $1 million in 30 years with an 8% return and you contribute $300 a month, you could technically start with $100 and still reach it. But if you only had 15 years, you'd need about $250,000 up front to hit the same target. The key takeaway is that the earlier you start, the lower your required minimum becomes. Time is the multiplier that allows smaller amounts to grow into life-changing sums. Most people don't start because they think small amounts don't matter. Here's why they're wrong. Let's say you wait until you can invest $5,000. That might take you 2 years of saving. But if you had started with just $50 per month during those 2 years, you'd already have a head start, not just in dollars, but in time in the market, which is far more valuable. Those extra 2 years could be the difference between retiring at 60 versus retiring at 65. They could be the difference between paying for your child's college in full versus taking on crushing debt, or the difference between freedom and being trapped in a job you hate. Small starts work because they let time work for you, while big starts often come too late. Most people could reach their minimum amount for compounding to work, but they sabotage themselves through common mistakes like lifestyle creep, where every raise or extra income is spent instead of invested; short-term thinking, where they expect instant returns and lose patience; fear of loss, which keeps them holding everything in cash where inflation quietly erodes value; and financial illiteracy, where they simply don't understand how realistic and powerful long-term compounding is. People chase big, flashy wins while ignoring slow, consistent wins, yet in compounding, Those slow wins are exactly what snowball into massive wealth, while big wins often end up being nothing more than expensive gambles. If you want the lowest amount to grow through compounding, there are certain rules you cannot break. You must start early because time is your greatest multiplier. Be consistent because regular contributions beat occasional large deposits, and reinvest all your returns so the growth remains uninterrupted. You also need to increase your contributions over time to keep up with inflation, and choose assets with a proven history of long-term growth, avoiding those that lose value as the years pass. Following these non-negotiables ensures that even a modest starting amount has the chance to build momentum and eventually grow into something substantial. Now, let's run the numbers. Say you start with $25 per month. That's $300 per year. If you invest that in an index fund averaging 10% annual returns after 10 years, $5,184 after 20 years, $17,349 after 30 years, $49,725. Now, $49,725 from $25 per month might not sound life-changing, but here's the twist. Along the way, most people naturally increase their contributions. That's when the growth explodes. If you double your contribution to $50 per month after 5 years, the 30-year total jumps dramatically. If you eventually reach $200 per month, you're looking at multiple six figures, all from starting with the lowest possible amount. Delaying your start even by a year doesn't just cost you 1 year's contribution. It costs you the compounding on all future years of returns. For example, starting with $25 per month at 20 years old versus 25 years old. If you start at 20, then you will have $74,872 at 50 years old. And if you start at 25, then you will have $45,580 at 50 years old. That's a $29,292 difference, just for starting 5 years earlier with tiny amounts. That's almost 30 grand you threw away by waiting. The lesson: even the smallest investment today is worth more than a larger investment tomorrow. The lowest amount you need to let compounding work is not just a math answer, it's a discipline answer. For some, it's $500 to start, and for others, it's $10,000 to feel momentum. But universally, the earlier you start and the more consistent you are, the lower your required minimum becomes. If you delay, your minimum will skyrocket, making it harder to ever catch up. If you start now, even with a modest amount, compounding will do the heavy lifting silently, patiently, and powerfully. Now, the bottom line is that the lowest amount you need to let compounding work is whatever you can invest today without hesitation. That could be $1, $5, or $50. The point isn't the size, it's the start, because the real secret is this: the earlier you start, the less you have to invest to reach your goals. The later you start, the more you have to contribute, and the harder it becomes.